Markets create this rally, then create a base, then drop down. This base can act as an area of supply for the markets to come back into and will sell. Welcome to another video. Today we're going to be talking about supply and demand trading and everything you need to know about supply and demand. So without wasting any time, let's jump into it. So supply and demand by the wise trader. Supply and demand in forex is understanding of how much hidden sellers and buyers are at certain levels in the market. It helps you determine whether there are more buyers and sellers in the market at certain levels and times. Okay, let's come into real life. Supply is the amount of product you have in a business. If you're selling books, the amount of books in your shop that you're selling is your supply, and the demand is the buyers, the amount of people that comes to buy your product. So that's basically what it is. Buyers of a certain currency and sellers at certain levels and times. So let's go over supply. Supply means sellers. If there are more sellers in a trading market, we use the term supply is greater than demand. So if there are more sellers, we say supply is greater than demand, meaning that there's enough stock to sell and the buyers are fewer. And supply in forex is very simple. Actually, both of them are simple, and you can only be on one side of the market. Either you're a buyer or you're a seller. If there's more sellers in the market, we use the term supply is greater than demand. A market with supply in control looks like this. You see downtrend, you see bearishness, see movement down, you see sellers selling this currency and stuff like this. So this is what it looks like, a market with supply in control. I'll later show you where to find the supply in the chart, but let's just go over this theory. And the term demand simply refers to buyers. If there's more demand for a currency, it's to be bought rather than sold at the current time. So if there's more demand, currency will move higher to be bought. So this is what a demand market looks like, to go higher because there's demand at certain levels. I'll show you how to find the demand also. So we say how to find supply and demand levels. So supply and demand zones are usually found after a major impulse, and as retail traders, we need to wait for smart money to leave footprints in the market for us to follow. So usually after a major impulse, either move up or down, the start of those impulse move have a ton of demand and supply left over that the market needs to capture before making its next move. So let's see, if we go to the chart I'm looking at right here, and this is the daily time frame. Okay, here we are on a clean chart. The market here went up, made a push up and a push down, and between these two moves you can see supply and demand zones. When the market was pushing up here, it was pushing higher and started coming lower. Let's start with supply zones. Let's look for where we saw impulse. That's big movement in the market. Number one, you can see at this point there was a very sharp movement. At this point, this is an impulse. There was a sharp movement here from this point here downward, and there was another sharp movement here downward. So what we'll be expecting for price to do is come back to this level and create another sharp movement. You can see price did not come back to this level, but price came back to this level, and as you see, if we had sold here, we'll be in what profit now if I had sold at this point. So supply and demand versus order block. What are order blocks? Order block are candles. Two types of order block: bullish and bearish order block. Bullish order block is the last bearish candle before the move up, and bearish order block is the last bullish candle before the move down. So let's see, let me show you other blocks on this chart now. You can see this candle. This was the last bullish candle. This was the last push up. After this move up, this was the last candle that pushed up before this whole move down. So we expect price to return there and create another leg, another move down, exactly what we did here. So this was called a bearish order block, the last bullish candle before the move down. So we are expecting price to come back to it and create another push down. So you can see it's it. And for a bullish order block is last down candle before the move up. So the last down significant candle. So you can see how small this candle was. Price didn't really meet it, so price used this one, this down candle here, these down candles, this down candle here. So price used this. So this was the last down candle before the move up. So you can see here, after price impulsively left this, it came back and bought off again. Alright, so let's go back to the slide. Supply and demand is more of a zone rather than a candle. Supply and demand is more of a zone rather than a candle. Let me explain that. So I've explained what order block is. So supply and demand is actually a zone, not a candle. This was the zone. As you can see, price moved up, came down and moved up. So this whole zone here is a demand zone. So this is a demand zone, because it created this push up. Buyers enter the market from here. So this is a demand zone that created this push up. So expecting price to come back and create another push up. So the other block is specifically one candle that we traders focus on for price to mitigate. Okay, let me explain that. So the other block is just one candle, and I told you it's the last candle before the move up. So let's see the last bearish candle here. This was the last bearish candle. So we mark it from the high to the low, the candle. Then you can see how price clearly mitigated that. You can see price mitigated this and created this move up and gave us an overall push to the side. So the demand and supply are zones. It's a very big zone where price tends to reverse from. As you can see, price came into this level one time, went up, came again, buyers entered, buyers. Overall we have buyers in this zone. So they say the market can retest a certain zone of supply or demand multiple times, while an other block is preferable tested once before making it invalid, which is exactly what happened here. The market tested this zone multiple times. You can see came into the zone 1, came into the zone one time, moved up, another time moved again, came into the zone. But you can see this other block down here, the last bearish candle before this push up, got tested just once before we created the move. Later on I'll be showing you how to put your take profit, your stop loss, and how to enter on these trades, how to mark your supply and demand zones. For a supply zone, when the market is in a downtrend with lower highs and lower lows, the lower highs are area of supply. Supply and demand, you need to understand market structure because they work hand in hand with charts. In an uptrend, market is moving higher. It's moving in waves like this, just as you can see, making higher highs. This is the higher high, this is the higher low, this is the higher high, this is the higher low, because to the lowest point that made a new high. This is the higher low, this is the higher high, this is the higher low. This is what for demand. Now for supply, that's making downtrend. Markets will be moving in waves like this. Markets will be moving waves like this. This will be the the lower high. This will be the lower low. This is a new low. This is the lower high, lower low, lower high, lower low, lower high, lower low, till the market makes a new higher high, then it's turns towards demand. You see, when the market is in a downtrend with lower highs and lower lows, the lower highs are the area of supply. So as you see, the lower highs here, this is a high, this is a low, this is a lower high, because we did not take out this high. We made a new low, so we made a lower low. Then we made a lower high, because we did not take out this high. Then we made a lower low, then a lower high, then a lower low. So this was supply in control. Sellers are stepping in supply. The opposite is for the demand, when you're making higher highs and higher lows. So it's high because buyers are pushing price higher. And for the supply zones, the lower highs are areas of supply. So this lower high, the top are areas of supply. So you can see here areas of supply, here they all work as areas of supply. Then for demand zones, the higher lows work as areas of demand, where buyers step in. As you can see here, it's worked here, it's worked here, and so on. So you see supply and demand patterns. So there are two patterns of supply and demand. Under the reversal pattern, we have rally base drop pattern, and this is an area controlled by bears and it can act as an area of supply in the upcoming trade setup. When the market rallies up, market creates this rally, then create a base, then drop down. This base can act as an area of supply for the markets to come back into and will sell. Areas of supply, so you see a lot of rally base drop here. Let's say this one was a rally base drop, rally base drop, rally base drop, rally base drop, just like that. So you keep on giving you supply zones to do your thing from. Then for the reversal, for demand zones, is drop base rally, the direct opposite. it can act as an area of demand because it's controlled by bulls. Alright, here's a good example of this for you. We have drop, base, rally. So price came back, filled that zone and moved up. And watch this, as price came back, it created another drop, base, rally. So price has to do what? Come back to what? Fill it again. So that's how we'll keep on going till we break it. So we created another what? Drop, base, rally. So we have to come back and fill this again till we break the zone. So alright, so for continuation patterns we have what? Rally, base, rally, and drop, base, drop. So this for continuation patterns. So for rally, base, rally, it works on demand zone, and for drop, base, drop, it works on supply zone. For rally, base, rally, we have this. Price rallies up, creates a base like a pause in the market, then continuous movement up. This rally, base, rally. So we're expecting price to come back here, fill this, and we'll take buys from here upward. So it's the continuation of this bullishness here, or bias. So let's say this way buyers took their profit, then paused a bit, then continue buying the currency. So this is when new buyers stepped into the market after old buyers took their profit here. So when price comes into here, buyers will continue again. That's what's expected of the market. So for a good example of drop, base, drop, we have this. Price drops, creates a base, slows down, then sellers continue. So we're expecting price to come back into the zones. So price comes back here and we continue the sell off. So this higher time frame, I will go over entries soon. So what I'm just saying is that this way sellers and big money came into play and did this. So price dropped impulsively. You can see this sharp movement down. You can see the sharp movement down, like it's crashing down. You see drop, base, then drop. So expecting price to come into these levels to continue the what? Structure, the bearish structure, to continue creating lower highs and lower lows. So time frame, a lot of people have difficulty in selecting time frame because a lot of people pick different time frames and they are confused about the market. So what I would recommend is you just choose a maximum of 3 time frames. With experience you'll be able to deal with more time frames, but for now choose a maximum of 3 time frames and stick to it. I advise daily for trend and structure, H4, that's the 4 hour, for zones, that's picking your demand and supply zones, then 15 minutes and 15 for entry. So just stick to 3 time frames and it will do for you. So entries. For entries, you can place sell limit orders at supply zones and buy limit orders at demand zones. But these are risk entries. Or you could just wait for your confirmation at the zones and take the trade. So keep your stop above the refined zone and take profit at the next zone or resistance level. Also exit your trade or break even your trade at the next supply demand zone. So this is what it means. Let's say for this rally, base, drop now, we're expecting price to come into here, this point. So this is the whole zone here. This is a big zone here. So you can set limit orders here, put the stop above the zone here, then take profit at the next zone. This was the zone that created this bullishness. You can put it here. You could follow structure because you can see this is a resistance zone that buyers are stepping in from, so you could just put it here in case of any resistance that will push price upward. So you just take your profit at that zone. As you can see, price melted from here and so on. So this is how you set it. This is one way of doing it, or you wait for confirmation. You wait for confirmation. I don't know which confirmation you use, but over future videos I'll be teaching and explaining smart money confirmations, that's risk entry and confirmation entry and double confirmation entries for you. So you can see this could be a confirmation, this inverted hammer here, price pushed up then down, then this, or this big engulfing candle. I'll be going over confirmation in future videos, so make sure you subscribe to the channel and click on the notification bell so you'll be notified anytime I post new videos. Alright, so another way of also doing this is refining your zone. So you could just, instead of using this whole big zone, because this zone is very big, instead of using this big zone, you could refine it to just one candle, this one candle before the strong push down, this one candle here. So you increase your risk to reward also. Let's see, if you're shorting from here, your risk to reward will be, see, 1 to 6.7. Then if you're shorting from here, your risk to reward will be higher, of course, which is 2.4. I'll be going over risk to reward later, but this is it. When you refine your zones, you get higher risk to reward. Alright, so let's go back. Good risk reward ratio. You need a good risk reward ratio to be profitable in forex. Trust me, you don't want to be taking 1-to-1s or 1-to-2s. You want to be getting at least 1-to-3, meaning that you need 3 bad trades to take out the profit from one good trade. So you need at least a 1-to-3 risk to reward. So let's use the trade as an example. Let's say we short from here and our stop there. So minimum should be targeting where 1-to-3. So we should be targeting where. Good. So this is the risk reward 1-to-3. So this should be the minimum you should get. This should be the minimum risk reward ratio 3. This if you are using trading view. If you are not, you should calculate your stop loss multiplied by 3 to get your take profit. Oh, I don't know if that's correct, but just calculate. Supply and demand have a clear risk reward and it says stop loss and it says take profit level. You shouldn't be having problem with that. Just as you can see, if you take a trade here, if you take a trade at this level, your stop loss should be here at these highs and your take profit should be at the next resistance zone or structure or whatever you do. As you can see, there's a clear break of structure here, so price retrace coming back towards clear this leg. Yeah, that's market structure. Supply and demand zones are clear to trade with. Do whatever you do. So my closing notes will be what? Practice. You need to put a lot of practice and be patient. Be patient for price to come into your zone. You need to wait for price to come into your zone. Don't try to trade at the middle. Don't try to catch every move at the middle. Just see the noise at this point. Just see all the noise here. Yeah, before coming to your zone. But if you wait for price to come into your zone, it will be very minimal. You have minimal stress and you could just let the trade play for you and do its thing. So don't give up on your strategy and yourself. Keep learning, keep striving, don't give up. Always be disciplined and stick to your rules, and trust me, trading pays those who are patient and are disciplined. Alright, we've come to the end of the video. Thanks for watching. If you got some value from this, make sure you click the like button, subscribe. I'll be giving this PDF out for free, this presentation slide, as soon as I get 100 likes on this video. So go on and click on the like button. As soon as I get 100 likes on this video, I'll be releasing this for free for everyone, so you can download and use it to practice. So this is a trade I caught this week on AUD/USD. It was a buy, it was a counter trade. I'll be making a video probably on it very soon. But you see, a trade I caught with a proper understanding of demand and supply. With a proper understanding of this demand and supply, you could really catch good trade. As you can see, it's 31% made on just this trade. It was a sniper entry. It was a beautiful entry on refined zone, refined M5 zone, that's 5-minute zone. Make sure you subscribe to this channel. I'll be teaching you guys all for free how to do this smart money concepts and that stuff. So as you can see, break of structure here, other things. So be sure to subscribe if you want to learn how to catch trades like this. Thank you very much for watching, and I will see you guys in the next video. Peace.